At long last, silver is making up ground. The use of gold in global currency is seeing a renaissance. I would contend that the increased activity is due to the fact that a larger number of wealthy investors are expressing worry, not to mention the addition of penalties and tariffs. The globe is already shuffling away from paper promises and treasuries. You may say, a trust-based system has been wasted after 4 years of nightmare internal and foreign policies under the previous administration. The same establishments that made fun of silver are getting ready for its rapid revaluation. Miles Franklin's chief executive officer has recently shown a 45-year chart trend that not only suggests, but shouts, greater pricing. Astoundingly, a confirmed technical objective of $96 to $100 per ounce has been set. However, that is only the start. A synchronized reset, the kind that goes unnoticed until it's too late, lies at the core of this surge. And whose plan is it anyway? Several sources close to the matter have revealed that economic strategists affiliated with Trump are planning a complete reorganization of the country's monetary system. Gold and silver are being recast as strategic monetary assets, with the dollar being sacrificed in its stead. Do you think it's over the top? Then tell me why institutional buying of gold has reached historic highs and why the price is already above $3,700. Give an account of the recent reclassification of silver as an essential resource, which led to tariffs and a rush to replenish domestic supplies in the United States. None of that is conjecture. The last act has started, following a script that has been subtly developing for years, while inflation has been rampant and faith in fiat currency has been eroding. So, how does this impact you personally? For whatever reason, prominent market watchers are now predicting a silver price explosion in the next months rather than years. I don't understand why big banks are getting ready for gold to soar above $6,600. Please bear with me until the end of this message has the potential to radically alter your perception of the financial system and your role within it. The physical demand that is entering the COMEX from London and Switzerland is, well, physical demand. Demand has skyrocketed. Even during stressful times, the normally 0.5% lease rate in London rarely rises above 1 or 1.5%. And even then, it's usually for a short while. Borrowing bars to short or cover a position may cost as much as 5 to 6.5% at the leasing rate. Also, that is unusual. The market is quite tight at the highest levels. To put it mildly, there has been an unprecedented influx of silver onto the COMEX. When it comes to technical analysis, a 45-year cup and handle formation, particularly one as mature as silver, may be the most potent you'll ever encounter. According to the current system, the first year of the cup would have been 1980, when the price was $50. After plunging to a low point in the early 1990s, roughly $4, it begins to rise again in 2011, nearly reaching the peak of the cup, not that it preaches anything, before settling back down for the handle. And now, we're back at $44, almost ready to go up again. The $50 level represents the upper lip of the cup, and once you break through it, there is absolutely no resistance. However, according to technical analysis, you would place $46 on top of the top by adding the difference between the cup's top and bottom, which is around 50 to 4. The next target upside would be between $96 and $100. Am I in my head? That is incorrect. At some time, one could anticipate silver prices in the triple digits. And then you find out that the government has floored the price of silver by reclassifying it as a vital element and a critical mineral. With that being stated, I made it clear right from the start that this was not about tariffs, despite all the noise over the past 6 or 7 months. It was never going to be. Reviving everything? was an elaborate hoax. We call this reshoring. Knowing that the world's wealthiest people appreciate the value of commodities like silver is a huge deal. When the largest traders in the US, known as institutional traders, start to pay attention and accumulate, the rest of us should too. We've been discussing this at the level of central banks for some time now, regarding the deliveries into COMEX, the accumulation by India, Russia, Saudi Arabia, and China. China, being the world's second largest producer, is flying around buying ore and sending it back to refining in China. Flying to Latin America to buy concentrate in ore directly from a miner and paying twice what the West will ship it back for refining. Why would the world's second largest producer of silver bother with all that trouble for something that hasn't done anything forever? Plus, I am clueless. I feel the same way about silver as I did about gold when it was in the 21st a year ago. After more than a decade of shackling, silver has finally burst free. It broke through the $44 level of resistance, which had stood for almost 14 years. Not just any breakout, though. For almost 50 years, this served as the catalyst for a technological formation. This design, according to analysts, is a cup and handle across generations. In addition to moving, these patterns erupt when they break. This is nothing new. Gold similarly tripled in price in the early 2000s after completing a comparable setup. The silver market is preparing for a reversal trend, with a price forecast of $96 to $100 per ounce. Having gained over 42% year to date, silver is currently selling between $41 and $44 as of September 2025. However, this is only the beginning. Resistance wasn't the only level broken by the breakout. Faith in the bearish argument was broken. Previously reticent institutional investors are suddenly pouring in. Traders are rushing to get in position for the next leg up as technical momentum drives enormous volume. Do not be confused. I am not describing a retail frenzy. As a result of this newfound awareness, hedge funds, asset managers, and even sovereign wealth funds are fueling the current fear of missing out, FOMO. The premise is too simple, and the potential reward is too great. A temporary shift to $52 is being predicted by several analysts. But when weighed against the long-term implications of this trend, that becomes insignificant. Reason being, this is more than a technical breakout. It's proof of a far larger trend. The change is coming to the monetary system, and silver isn't merely a passenger. At the forefront of it all is it. And now for the exciting part. We can't understand the urgency just by looking at price action. The silver market is currently experiencing physical turmoil as a result of another developing pressure point. Plus, $100 might seem like a lot when things finally boil over. After a lengthy period of consolidation, it finally broke through and hasn't looked back. Previously, it had been attempting to break out from the $2,200 range, consolidating, and then trying to break out again. For the time being, I'd say that's about the silver market. In my opinion, it is the world's most underappreciated asset. It appears that the United States now considers it important, indicating its significance. As far as asymmetrical chances go, I can't think of many that provide such a low risk with a high potential reward. It happens once every generation for an asset such as this. The drivers are, therefore, likely to wake up to the large bucks. One may make the case that the general population has not even joined this demonstration as of yet. Once they all come to their senses, what will happen? The fact that high-ups are pushing something before the general public does is another contrarian sign. For what it's worth, I believe silver's recent surge is the primary factor propelling gold and silver prices. the use of gold in global currency is seeing a renaissance. Fortunately, someone in this government seized President Trump and warned him that the consequences would be severe if they did not act now. With the globe increasingly turning away from treasuries, dollars, and paper promises, not to mention sanctions and tariffs, this is our final chance to bring part of this home. You could say that a trust-based system has wasted most of it after 4 years of nightmare internal and foreign policies under the previous administration. Also, I'd cast another ballot for Trump if given the chance. But I disagree with the way he's alienating even his friends and allies, like India, with his 50% tariffs and a host of other EU and Canadian nations. Perhaps there is a greater force at work, something we have discussed extensively. Yet, I believe it is only the start, to be honest. Listen, a few weeks ago, someone from Goldman Sachs said that if the market believes the Fed has lost its independence, then who will replace Lisa Cook? That's right, a Trump bobo. You see that the originator of the Mar-a-Lago Accord, Stephen Meehan, has replaced the final remaining Fed officer. This is hardly the first time the Fed has lost its autonomy. Banks are speculating as much as $6,600, with $4,000 being the base case for most of these institutions. If you look back through history, you'll see this happening with several presidents, but they only give you crumbs. Look, if you were to split Goldman's predicted silver price of $5,000 by 70, the resulting price would be significantly more than the metal's average over the last century and 10 times higher than its current extraction price. You're talking about silver that costs roughly $75. Therefore, Elijah, this is only the beginning for me. To be honest, I agree. And I think we've all been mentioning how early we usually follow suit, but I'd prefer to be months or even years ahead of schedule rather than 60 seconds when the switch is turned on. The physical silver market is seeing some kind of disruption, and it isn't limited to supply alone. Trust is key. Lease rates in London are currently hovering at an astounding 5 to 6%, while premiums are skyrocketing, and delivery windows are becoming longer and longer. These figures do not add up. They proclaim a scarcity. Fleeing in terror, they let out cries of terror. This is just the beginning of a full-scale physical squeeze, the kind that will break the link between paper and physical prices and shake up the whole financial system. Check out COMEX. There is some misleading information in the fact that warehouse inventories reached a record high of 507 million ounces in August alone. Plenty of silver isn't actually for sale. Someone is hedging it, leasing it, or setting it aside for delivery. A 140-year low has been reached by LBMA London inventories, which have dropped to 155 million ounces. You read that correctly. 440 years. Carriages pulled by horses were the norm when silver was rare in London in the past. Despite this, retail demand is still in its infancy. Dealers are cutting back, product premiums are skyrocketing, and high net worth individuals are buying. Perhaps you could order a 100-ounce bar of Johnson Matthey. Above spot, you'll spend more than $2 per ounce, if you can ever locate one. Let me break it down for you. There is insufficient silver to distribute. The demand from industries is simply skyrocketing. Metal is being removed from circulation by institutions. The few people with knowledge of the situation are securing every supply they can get their hands on. No, this is more than a squeeze. The fight is on for the last supplies. Additionally, the price will correct higher with greater vigor if the gap between the two becomes broader. So, what's the reason behind this squeeze? Who is making such a large metal hoard? Also, why are they being so stealthy about it? The solution is hidden in the shadows of the financial system, where insiders and central banks are implementing changes that the public is completely unaware of. The company, however, has been extremely busy as of late. I would contend that there are far more wealthy investors who are becoming worried, so it's active. The truth is that making money is simpler than keeping it. Many people who have, in my opinion, are probably nearing the end of their lives or their careers. Things are happening here, and they're watching. An intense fascination has emerged out of nowhere. To answer your question, the general population is still very numb to the pros and cons. I'll address your question regarding premiums later on, but in the past few weeks, I've had extensive conversations with individuals like your father, which has led to record high public involvement in the stock market, approximately 55%. Absolute peak, greater than its 1929 record high. Over the .com threshold, at your convenience. Consistent with this idea, the retail audience is more involved in options than ever before, leading to unprecedented speculation.